Welcome to Section 5 of our Accounting Standards Codification 323 training series on the equity method and joint ventures. In this section, we bring together three of the most tested and most misunderstood areas of equity method accounting: how distributions from investees are treated, how joint ventures work under United States generally accepted accounting principles, and how every major equity method scenario translates into a complete journal entry. Let us get started. By the end of this section, you will be able to explain the logic behind dividend treatment, apply the equity method to joint ventures from initial contribution through distributions, and write out the full journal entry for every scenario you are likely to encounter in practice or on an exam. These skills connect directly to the financial statement presentation topics coming up in Section 6. Here is the key thing about dividends under the equity method. When your investee pays you a dividend, you do not record income. You reduce your investment balance instead. The reason is straightforward. You already recognized your share of the investee's earnings when they were earned, not when they were distributed. Recording a dividend as income a second time would be double counting. Think of the dividend as a liquidating distribution. The value was already on your books. The cash simply converts part of that investment balance back into cash. Up next, we will look at how joint ventures fit into this same framework. Watch out for this one. The most frequently tested mistake in equity method accounting is crediting dividend income when a distribution is received. Under Accounting Standards Codification 321, which covers equity securities that do not qualify for the equity method, dividends are income. But under the equity method, you have already recognized that income through the equity pickup. If you credit dividend income here, you are reporting the same economic gain twice. The wrong entry also leaves your investment balance too high because the distribution should have reduced it. Keep these two standards clearly separated in your mind, and the next section on joint ventures will reinforce exactly why this distinction matters. Now let us turn to joint ventures. The defining characteristic is joint control. No single investor can make major decisions alone. Every significant move requires the agreement of the other venturers. Under United States generally accepted accounting principles, that structure triggers the equity method under Accounting Standards Codification 323. You do not proportionately consolidate assets and liabilities. Instead, you record a single investment line on your balance sheet and pick up your share of the joint venture's earnings and losses each period. The initial investment is measured at the cost of whatever you contributed, whether that is cash, property, or other assets. Let us look at what happens when you contribute non-monetary assets. The surprising part is what happens when you contribute a non-monetary asset, such as property or equipment, to a joint venture. You are effectively selling a portion of that asset to your co-venturers. So you recognize a gain or loss on contribution, but only to the extent of their ownership interests. You cannot recognize a gain on the portion you still effectively own through the joint venture. After the contribution, the subsequent accounting mirrors everything else we have covered. Pick up your share of earnings and losses each period, reduce the investment balance for distributions, and apply the same impairment test. Next, let us walk through every major journal entry type from start to finish. Let us build the complete picture one entry at a time. When you first acquire an equity method investment, you debit the investment account and credit cash. That establishes your cost basis. Each period when the investee earns income, you debit the investment account and credit equity and earnings of investee for your proportionate share. When the investee reports a loss, you flip it. Debit equity and loss of investee and credit the investment account. And here is a critical rule you already know from earlier sections. You stop recognizing losses once the investment balance reaches zero, unless you have guaranteed the investee's obligations. The next entry type covers what happens to that balance when a dividend arrives. Three more entry types complete the ongoing accounting. First, dividends, cash in, investment balance down. Second, when you allocated a basis difference to depreciable assets at acquisition, you amortize that difference each period by reducing your equity in earnings and reducing the investment balance. Third, if the investee records other comprehensive income items, such as pension adjustments or hedging gains, you pick up your proportionate share through your own other comprehensive income section, with the offset going to the investment account. Notice the pattern. Every entry flows through the investment account. That single balance sheet line is the heart of the equity method. Two more critical entries remain. When an investment suffers an other than temporary decline in value, you record an impairment loss for the difference between the carrying amount and fair value. That write-down is not reversible under United States generally accepted accounting principles. When you eventually sell the investment, the entry removes the investment balance and records proceeds. Any difference between the two is a gain or loss on sale. The final step that candidates often forget. At the point of sale, you must reclassify any accumulated other comprehensive income items that were being tracked from the investee. Those amounts transfer out of accumulated other comprehensive income and into earnings. This completes the full life cycle. Let us close with your key takeaways. Let us bring it all together. Dividends reduce your investment balance because the income was already recognized when earned. Joint ventures always use the equity method under United States generally accepted accounting principles, with no proportionate consolidation permitted. Asset contributions recognize gain or loss only on the co-venturer's portion. And across the entire holding period, every entry either increases or decreases that single investment balance. Master that flow and the journal entries become second nature. Thank you for completing this section on distributions, joint ventures, and journal entries. Section 6 covers how all of this appears on the financial statements and what disclosures a ASC 323 requires. Thank you for watching. Subscribe for more training from P&J Group.